Today, we're talking about one of the biggest debates in crypto right now. Will we actually get an alt season this cycle? Recently, I made a video talking about the possibility of an alt season this cycle not turning out to be like the past, where everything just runs together and you make money no matter what you buy. I spoke about the possibility of many narrative-driven mini alt cycles instead, and oversupply of altcoins combined with lack of liquidity being a big reason for that. That means this cycle is better for traders, in my opinion, than investors, which is why I've been selling weaker altcoins and focusing on short-term trade. If you want to check out that video for more details on this, I'll leave a link to it in the comments down below. Now, what struck me about the comments on that video was a lot of people disagreeing for one common reason. There were many similar comments like, just wait for quantitative easing, or once the money printer turns back on, alts will pump. Now, this idea comes from the belief that when the US Federal Reserve, which controls interest rates and money supply, starts printing more money, it makes risky assets like crypto go up. And that's why everybody is banking on this idea of a quantitative easing. So today, I've brought on someone who understands how the economy really works behind the scenes. In this video, we're lifting the curtain and taking you behind the scenes to meet one of the experts that leads our private community at 𝗟𝗶𝗃𝗃 on all things macroeconomics. Jarrid is our in-house economist here at 𝗟𝗶𝗃𝗃. He has over 15 years of experience in the financial world, working as a research analyst for a major investment fund and a hedge fund before joining the crypto space. And today, he's here to chat to me and you about what lies ahead for the economy, and hopefully by the end of this video, answer the one question everyone in crypto seems to be waiting on. Will the Fed actually print more money in 2025 before the crypto cycle is due to end? Hey, Jarrid, welcome to the channel. Thanks for being here with us today.
Yeah, thanks for having me, Annie.
Yeah, I'm really excited to speak about this because, like I said in the intro, it's a very big topic. You probably saw my video on altcoins where I'm like, I'd rather trade this cycle than hold anything. And so many comments were like, just wait for QE, just wait for QE. So I thought there's no better person to bring on than you. And I want to start with the basics because people keep saying that, wait for QE, wait for the money printer to be turned back on. So I want to start by asking you, what does that actually mean? Like, give it to us in simple terms. What is quantitative easing?
Yeah, so at a high level, the Federal Reserve, one of their main jobs is to maintain stability in the United States economy. And they do this through monetary policy. They've got multiple tools that they can use that have impacts on the economy and eventually financial markets. But over the last 30, 40 years, the two main tools they've been using are adjustments to the federal funds rate. So when you hear the Fed cut rates, that's the rate they're talking about. It's the federal funds rate, the rate at which they're lending to banks. And then they've also been using quantitative easing post GFC in 2008. Over the last 20 years, we've had 4 rounds of QE where the Fed has stepped in and provided that. But what exactly is QE? How does it work? So QE is a type of non-traditional monetary policy, and it could be implemented by any central bank of any nation. So lately, we've had the Central Bank of China providing QE for their economy. There's talk that Europe, the ECB, and the Bank of England are likely to potentially start QE in Europe. But in this case, we're talking about the Federal Reserve. And so when the Fed does QE, they are doing large-scale purchases of assets in order to stabilize and stimulate the economy. And so QE is typically implemented after there's been some sort of major event. And it's usually when they've already lowered the federal funds rate to their lower bound, which is historically has been 0.25%. And after they've lowered interest rates, if the output of the economy is still below their target, then they have in the past 4 rounds implemented this QE. And so what they do during QE is the Fed will enter the open market. They start to purchase assets. And when they go out and purchase assets, these historically have been mortgage-backed securities, agency debt, and treasury debt. When they purchase these assets, they're creating new bank reserves. And so when they create new bank reserves, the banks with extra reserves can go out and make more loans. And as companies and individuals take more loans, that starts to restart re-stimulate the economy. And so this is really the process of what people would call money printing. It's this creation of new bank reserves by the Fed buying assets. And so with these newly created reserves, the Fed often will buy securities from the major financial institutions. These purchases are effectively swapping the bank's investment holdings for cash while increasing the overall money supply. And so with money, banks are more inclined, like I said, to make loans. Making more loans is what will reboot and stimulate the economy to start growing again. And so that's why the Fed has used QE in the past.
So the reason why they start to print more money is to stimulate the economy again.
Yeah. The whole point of quantitative easing is they've used their first main tool, the Fed funds rate, to lower interest rates, because lower interest rates encourages individuals and businesses to take on new loans at these lower rates. And so as interest rates go lower, investors are often will move more further out on the investment risk curve in order to maintain their yields and rate of returns. And so while the lower interest rates are getting individuals and businesses to take on new loans to re-stimulate the economy, the financial market economy also gets a stimulus, because investors are trying to maintain their rates of returns and their investment yields. And so they start to go out and buy, stocks, crypto, things of that nature. And this is why QE often will lead to larger stock gains after QE is started. As the Fed starts to buy assets, market participants will tend to have an increased confidence in asset prices they're buying. So there's that psychological effect. We do have to understand there are drawbacks to QE though. One of the effects of QE is it increases the money supply, and that does stimulate inflation going forward. And so that's why QE is more of a last resort tool, because lowering the Fed funds rate also is inflationary to the economy. And so then adding QE on top of that just increases that inflationary. And so if the economy is growing below trend and the unemployment rate is still, at a manageable level, then increase in inflation is okay for the economy. But if you already have high inflation, so right now, we're right about that 3%. So in December, CPI year over year was 2.9%, up from 2.7%. So that is above the Fed's 2% target on inflation. Meanwhile, unemployment rate is still in that 4.1 to 4.2%. So historically low. That is not an environment where the Fed is likely to look to get aggressive with QE at this time, because if they did roll out a new round of QE, it could create higher inflation, which could eventually push the markets and the economy into a recession.
QE has happened 4 times before. What was going on in the economy each time that made them decide to do it then?
Yeah, so let's go back to 2007. At the time, the U.S. economy was having a major housing bubble in the United States. Many of you have seen the movie The Big Short. The banks and the financial institutions were taking these mortgages on residential real estate in the United States, chopping them up and repackaging them into security derivatives, which are now known as mortgage-backed securities. And meanwhile, the credit rating agencies were saying that they were low-risk, top-quality assets. When you actually looked underneath, they were very high risk. And as we found out, 2008, they all started to implode, and that's what led to the Fed cutting rates in September of 2007. And then we had the great financial crisis in 2008, where the banks had to be bailed out by the Fed via a QE. And so QE1 was announced in November of 2008, over a year into the great financial crisis. By the time the Fed got around to announcing QE1, the Fed had already lowered interest rates from 5.25% in September 2007 to the lower zero range of 0.25%. With the interest rates already at zero and the economy not rebounding per the Fed's targets, they announced QE in an effort to start to stimulate the economy again. Also, something to note, before the first QE was announced, the S&P had already declined 57% from its closing peak, which came 21 days after the first Fed cut on October 9th. So as you can see here on the chart, this orange line is the federal funds rate. So when we talk about the Fed cutting, that's represented by this line. And you can see here the markets were going up into July of 2007. And then the Fed cut for the first time here on September 18th. This is a weekly chart. So 9 days after that, the S&P 500 peaked. And then the Fed continued to cut rates through the end of 2007 through 2008 as the housing bubble collapsed and the banks needed to eventually be bailed out, which you had Lehman Brothers, which was the big bank at the time, go under in the end of 2008. And at that point, even lowering interest rates to 0% was not enough to stimulate the economy and support the financial markets at the time. And so that forced the Fed to do QE1. So you could see here by this white vertical line, that was the announcement of the first ever QE. And so again, from the peak to the low in March of 2009, the S&P 500 had already declined. So by the time we got the first announcement of QE ever, the US stock market index had already declined almost 50%. And so then from there, obviously with that, between March of 2009 and March of 2010, the Fed ended up purchasing $200 billion in agency debt. They bought $1.25 trillion in mortgage-backed securities and $300 billion in long-term treasury debt. So massively stimulating at the time. And that's where we saw shortly after that announcement of QE, the markets bottomed and started to head higher again. About a year later, that's when the economy in the United States was still performing below the targets of the Fed. That then caused the Fed to announce another round, so QE2 2010, because again, they didn't feel that the economy was growing and performing at the level that they had hoped for. Just like in QE1, in 2010 with QE2, the Fed had continued to hold the Fed funds rate at 0.25%. So again, this is a zero interest rate environment. And then we got the announcement of QE2 on November 3rd, 2010. And this time, the Fed went into the open market and purchased long-term treasuries. They purchased $600 billion of long-term treasuries, another $75 billion per month of those treasuries all the way through the second quarter of 2011. And then they concluded this second round of QE in June of 2011. That's this period of time. This white line was the start of that. And then, the market was doing okay. The economy was continuing to improve. But again, GDP growth was still below the Fed's target. Unemployment was still not at the Fed's target. And so in September of 2012, economic activity had been expanding, but we were still not near the Fed's target. And so the Fed decided to, back in September, announce this third round of QE, where they announced that they would do monthly purchases of $40 billion in mortgage-backed securities again, and a plan to increase long maturity treasury security holdings at about $45 billion per month. Now, this third round of QE was different from the previous two rounds because the Fed didn't specify the total purchase amount or a timeline of how long they would be purchasing assets in the open market. So that was a slight deviation. But what wasn't different versus the first two rounds of QE is, again, as you can see on my chart here, the Fed funds rate remained at 0.25, so the lower bound. So what I just want our audience to understand is that with the great financial crisis, the Fed lowered interest rates to basically 0% and then announced QE1, continued to hold interest rates at 0, announced QE2, and then while still holding rates at 0, then finally announced QE3 because the economy had suffered so much as a result of the great financial crisis, which many institutional investors and economists actually think that the 2001 dot-com bubble bust and the GFC were sort of a part one and a part two of a larger period, financial recession. But there was so much damage done to the economy and the financial markets that, in fact, while interest rates, again, being held at 0% for 1,372 days, which is about almost 4 years, so 3 3/4 of a year at 0% interest rates, the Fed still had to come out and do 3 rounds of QE because the economy was not able to get to growth targets and employment targets that the Fed had. And so that's why it had to take all these rounds of QE, because the economy and the markets needed that much stimulus. But going back to QE3, in December of 2013, that's when the Fed announced the tapering of its purchases under that third round of QE. And then the purchases completely stopped for the QE third round in October of 14. And so that's where QE stopped for the market. So from the first announcement of round one, to the end of QE, you're talking about over 2,160 days in terms of years, that it's going on 6 years. And so as I zoom out here, you can see, what did all of this QE do for markets? Well, in 6.2 years, the markets went up 200, this is the S&P 500. So the US index market, from the low of March 2009 to the peak at the time of May of 2015, we had a 200% return as a result of these QE efforts by the Fed. At the time of October 29th in 2014, when the Fed announced the end of QE, since January of 2014, again, the Fed had been tapering QE by about 10 billion a month. So even towards the earlier part of 2014, the Fed had already been communicating to the markets that it was tapering. And again, it was doing this by about $10 billion a month. Quantitative easing is where the Fed is buying assets and putting it on their Fed balance sheet. So when we say tapering, that means they are letting these assets, as these debt instruments mature, roll off the balance sheet. And so tapering means the Fed's balance sheet is in fact going lower. The Fed was doing this, letting their balance sheet go down by about $10 billion a month since January of 2014. So then by the time we got to October 2014, the Fed announced that it was going to reduce its purchases by a final $15 billion a month. At the end of that month, they felt that they had seen, and I quote, a substantial improvement in the labor market, unquote, since they announced QE1 all the way back in November of 2008. So again, it took almost 5 years for the Fed to finally feel like they had seen enough improvement in the labor market to stop stimulating the economy. Also, at the same time, the Fed decided to keep the short-term interest rates near zero. So even as they ended QE, they still maintained the Fed funds rate at that 0%. And at the time, the Fed, they were quoted as saying, for a considerable time. So they didn't even have an end date when they would start to hike rates again. So even after beginning tapering, the Fed continued to communicate that interest rates would need to stay low after the end of QE in order to maintain that trajectory and growth in the economies.
You're really showing me how long things take. When decisions are made, it takes a long time for it to play out in the markets. And my question for you is that some people believe that the Fed will print money again this year. And that's why we're going to see our alt season. But in your opinion, what is the likelihood of that actually happening?
Yeah, that's a great question. And obviously that's the $1 million question at this time. I would say the probability of the Fed announcing a QE program in 2025 really would depend on the evolving economic and financial landscape. Again, like I said earlier, QE is typically deployed as a response to an economic or a major market stress. So the likelihood of announcing QE at some point in 2025 really would hinge on one of several factors happening, which I can explain in more detail. But I would just say broadly, as of today, financial markets are showing resilience. Inflation has moderated, but it's still above the Fed's target. Meanwhile, the U.S. economy has been avoiding recession as the labor market has held in in the low 4% range, despite the Fed raising rates through 2022 and 2023. So based on current conditions, I would say the probability of QE in 2025 is probably low, maybe moderate, as bearing any significant economic or financial shock. With the new US president, Trump is now back in office. This outlook could change rapidly, again, if certain conditions arise. As I shared earlier, I believe, based on the data, that inflation in the United States will continue to be flat to down as we move through the end of the year, as the basing effects, mainly coming from housing and energy, go down. The transfer payment adjustment was much lower this year. So I see a lot of factors putting downward pressure on inflation. Meanwhile, when we look at unemployment data, we look at credit card debt, auto loans, delinquencies. We look at bankruptcies, layoffs in companies. There's a lot of factors putting upward pressure on unemployment. So if in fact inflation comes down aggressively, especially in the back half of the year, we see a real tick up in unemployment rate, then that is more evidence, because again, the Fed is reactionary. They're never going to get out in front of the markets or the economy. It's too much of a risk. They're going to make a mistake. If we get lower inflation, higher unemployment, then that could give the Fed green light to be even more dovish than they are today. If they're more dovish, they could cut rates more aggressively. And a dovish Fed at this point in markets is going to be better for stocks, better for crypto, versus like in December at the Fed meeting, the Fed came out pretty hawkish. Their forward projections announcing only 2 cuts in 25 was very hawkish to the markets. And that sent both the stocks and crypto markets down mid-December and early January. And so also there's Trump factor. So Trump is back in office. Fun fact, Trump in his first term actually appointed Jerome Powell as chair of the Fed and quickly regretted it.
Really?
Yeah, I mean, Trump replaced Janet Yellen with Jerome Powell in his first term in 2017 or 2018, but was unhappy with Powell the entire time. And already last week in Trump's first week as U.S. president again, he's already out communicating to the world and the financial markets, I want oil down. I want OPEC to help me. So again, OPEC, mainly Saudi Arabia, has been communicating they're sitting on excess supply, about 6 million barrels of excess supply that they could release onto the market. That would drive oil prices down. Trump, one of his mandates in this term is drill, baby, drill, getting more oil production in the U.S. And so again, if you saw, he actually said last week, I believe in one of his interviews, he wants oil below $50 a barrel. And so that also would be another factor of lower oil is lower gasoline prices in the United States, another factor to put downward pressure on inflation. But aside from what he was saying about oil, Trump was saying, I want lower interest rates. And so he's going to, and he's already started to put more pressure on the Fed to lower rates more aggressively at a faster pace. And so that could push the Fed to start to stimulate even more. But again, going back to your main question, like what is the chances? I don't think it's smart to say that this time is different. We didn't even really dive too much into the QE that we saw in March of 2020. But just to briefly touch on that, the long story short on that is the Fed was already cutting rates in the midpoint of 2019 through the end of 2019 down to about 1.75%. And then in March with the COVID lockdowns and the pandemic, the Fed did an emergency. And so you could see here in March of 2020, the Fed had to do 2 emergency meetings. The first emergency meeting being March 3rd, they cut 50 basis points to 1.25%. And then again, March 15th, they cut another 100 basis points, bringing the Fed's funds rate back to 0%. And at the same time is when they announced the 2020 QE program. So in terms of the probability of us seeing a QE in 2025, all
we
4
need another
times.
COVID. Is that what you're saying?
Yeah. Yeah, I mean, that is one risk. I mean, if you had another sort of health scare at a global basis, and you had lockdowns, because The other thing, that we can talk about if you want is the fact that since 2020, monetary policy over the last 40 years has been the dominant factor of navigating the economy and financial markets. But in 2020, the US government started to use their own fiscal spending to create a new dynamic that Lynn Alden, who's a big research and economist, has coined fiscal dominance, and nothing stops this train with the amount of government deficit spending we've seen in the last couple of years. 2020 kind of changed the game in terms of market and economic dynamics, because now for the first time in the last 30, 40 years, the US government, a lot of it coming through their stimulus checks that they mailed checks to individual citizens in the United States. They also had what's called a PPP loan program, giving small businesses and businesses basically free loans to stimulate. That drastically impacted, the rebound in markets in mid to late 2020, in addition to what the Fed was doing with QE. So again, and that spending has also been kept up here going into this year. So not only is it about whether or not the Fed is going to do another round of QE in 2025 or by the time the crypto bull market is over, we also have to pay attention to what the government is doing, because now with Trump back in office, he is not one to sit on his hands for too long if he's not getting the results that he wants. And he has communicated that he wants to break inflation. He wants to bring back, jobs and manufacturing to the United States. He wants to get the U.S. economy growing, and he wants a high stock market. And if he cannot pressure Powell and the Fed to cut rates and possibly do a QE, he might, through his abilities of executive orders or putting pressure on Congress, potentially, if there is something like a health scare, a major economic event, a banking crisis, or some sort of major drop in the stock market, 10 to 20% drop in the stock market in the short term, he could take measures into his own hands and start to, create these spending programs again that could, in a way, mimic the same effects that QE does.
So it's sounding to me like it's probably not the most intelligent idea to bank on QE in order to get our alt season, but there could be other things, because we now have Trump in power, that might give it to us instead. So the reason we keep talking about 2025 is because depending on what model you use for Bitcoin, most people are expecting that this cycle ends in the last quarter of 2025. Is that sort of aligned with what you think about this cycle as well?
Yeah, that definitely aligns with what I've been seeing. Now, obviously, we inside the TTC community, as you've taught us through the TBD system, is that we are, for the most part, shorter term swing traders. So we are reactive. So we don't really care when the bull market ends and when the next bear market. As you've taught for many years, you actually had almost better results in the bear market than you do in
I
bull
love
markets.
those big drops. Those big 40-50% drops, they're so good.
Yeah, I know. But as I'm sure most of the audience is probably thinking about their spot bags and their spot holdings in terms of this conversation. And so in addition to using our market timing methods and counting the different levels in the markets, I also have been doing some analysis using what is called Hurst cycle timing. So as you can see here, as way of background, so J.M. Hurst was an American engineer who in the 1960s and 70s, he was the first researcher to use the power of modern computers to investigate cycles in financial markets. So Hurst is widely recognized today as the father of modern cyclical analysis. And Obviously, his analysis was done on the major US stock market indexes, but a few of his students in recent years with the advent of the crypto markets have then reanalyzed these Hurst cycles for the crypto markets. Inside the Hurst analysis, there's typically 4 dominant cycles. So they're all based on different time cycles. In crypto, the main one is the 4-year cycle that's been identified. And so this is a 48-month cycle. There's a 20-month cycle, a 10-month cycle. And so there's these different cycles that have been proven. And that's what you can see on my chart here. But for our purposes, the red line is the 4-year Hurst cycle. So the red line is the 48-month cycle, and it's exactly 4 years in crypto markets. And so when I measure the length from the high point of a market to the low point of the cycle low to the high and matching the low and the high of the Hurst line filter, we can see that in prior cycles. So again, this is a Bitcoin chart. So I don't have it for, you know, like the total 3 market cap, but we could easily do that. So, but I'm just kind of obviously because Bitcoin leads everything. And so we get, you know, we get Bitcoin moves and then it consolidates and then we get all season. But in terms of the Bitcoin cycle, in the first cycle, we got the peak 812 days. And then in the second cycle, we saw the peak at 182 days. In the most recent cycle, so calling it the third cycle, we saw the length of time from the lowest point to the cycle high was 976 days. And so, you know, looking at the last cycle, the third cycle, BTC's first price peak came 98 days before the peak in the Hurst line. And then the second peak came 111 days after the high point of the Hurst cycle line, which again, the third cycle was different from the first 2 cycles because in the first 2 Bitcoin cycles, we had a climax blow off top and then then we had a peak and then we had a drop versus this most recent cycle, we had a double top pattern that signaled the top. One thing that the audience should also keep in mind is that as Bitcoin matures as an asset class, and this is especially relevant this cycle with the US Bitcoin ETFs that were launched in January. Also, there's been a huge surge in futures volumes. Now the main exchange for future activity is the CME, which is catering to a lot of US and institutional investors. You have a lot more institutional money driving the price of Bitcoin in this cycle than you had in prior cycles. So prior cycles were mainly driven by retail investors and small institutional funds. This cycle, a majority of your capital flows that are driving higher prices are coming from these long-term, slow decision-making institutional funds, pension funds, insurance companies, long-term investors, you know, buying Bitcoin via the ETFs in their retirement funds. And so as a asset class matures, you tend not to get these extreme blow off tops and then straight back down. You start to get what looks like a longer term topping process. So a common quote in US stock market and US financial markets is that tops are a process, bottoms are a price event. And so again, given that there's so much involvement with larger institutions in this cycle, you could see this topping process be a much longer but less aggressive price upward trajectory move as well. And maybe the last cycle was an indicator with the double top. And so who knows what we get this cycle. For all we know, we might actually consolidate for, you know, a couple months. And then eventually there's a point in the economic cycle and the stock market cycle, we roll over depending on what goes on with the US dollar or interest rates in the United States. You know, kind of going back to when alt season, you know, the other dynamic that is different this cycle than prior cycles is that a lot of the capital flowing into Bitcoin, like I said, coming from large institutions and coming through the US Bitcoin ETFs and MicroStrategy, Michael Saylor is buying a lot of Bitcoin, is that capital this cycle is inside vehicles that doesn't allow that capital to then be rotated into altcoins easily as Bitcoin consolidates. And so in prior cycles, money would flow into Bitcoin, it'd have its move up, it would consolidate, capital would rotate into altcoins, then they'd have their run, and you'd kind of have this back and forth cycle. But this cycle, that capital inside Bitcoin is, for lack of a better phrase, stuck in Bitcoin and is not able to go. And we even saw that, 2 weeks ago, right before the inauguration of Trump comes out, launches his Trump coin, and it goes up to $15 billion valuation in 48 hours. But what was the rest of the market cap doing? It was going down. So alts were selling off as Trump coin was going up, which shows you that there wasn't new capital flowing into altcoins. It was rotating within altcoins. Meanwhile, Bitcoin was more or less going sideways. And so it's kind of, we have two crypto markets now. We have the Bitcoin market and we have the altcoin market. And this cycle has proven to be a little bit more of a selective. And I know you've been sharing, with the audience and the TTC community that perhaps this alt season is going to be more specific narratives, specific categories. We're not likely to see this all alts rallying together. And so you have to identify the better narratives, whether it's the meme coins or AI or what have you. And we can't count on something like a QE stimulus to really bring in liquidity to all, both crypto and Bitcoin. And so, again, we just got to be, conscious of that. If the pattern of the Hurst cycle repeats from the prior 3 cycles using the main cycle of the 4-year cycle, if that pattern repeated in this cycle, here are what we should expect in terms of potential price peaks for Bitcoin in this cycle. If we were using based on the first cycle, it would have told us that the price peak for Bitcoin would have been September of 2024. Obviously, that did not happen.
We're still here. We're still fighting.
We're still here. If you were to base this cycle's price peak for Bitcoin on the average of all 3 prior cycles, so when you average all of their price peak lengths, it was about 138 days before the Hurst cycle peaked. That would tell you we should expect a Bitcoin peak this cycle around March 11th of this year. So, only another, 6 or so weeks away, which many people are not going to like that.
No, that won't.
If we use the 3rd cycle first peak, then we would expect a peak sometime in early May, around May 9th. If in fact we looked at the 2nd cycle, had the 1 peak, then it's telling us early July. And then using the 2nd peak of the most recent cycle, it pushes us all the way out to December. So essentially our range of when Bitcoin, if the pattern repeats using Hurst cycles, we could see a Bitcoin price peak for this cycle anytime between mid-March to December of this year. Now, obviously, just using the general 4-year cycle, using, the return on investment, metrics and the timing metrics, more of a traditional timing cycle on Bitcoin would say we should expect the cycle sometime in the October timeframe. So for me, I'm really looking at this summer as a highest probability case for a potential peak. And then lower probability for earlier, March, April, May. And then again, slightly lower probabilities extending out to September, October, November. But even if we got all the way to the end of the year, that's 10 months left for the Fed to cut interest rates to 0%, which again, we're at 4.25%, 4.5% today. The Fed saying 2 cuts this year. The market went to 1 cut, now back to 2 cuts. And so if we only cut 2 times this year, then that puts the Fed rate at 3.75%, which is still a good ways away from 0%, which based on the 4 times we've had QE, we've had 0% interest rates before QE. So in order to get QE again this year in the next 10 months before, probable potential peak in Bitcoin and thus alts as well, we would need some major events to happen to change either the U.S. economy or to cause a large stock market move down, 10 to 20% down, to get either the government through their fiscal dominance or the Fed through their, cutting rates and QE for something like that to show up. We've also had other things already happen in the last year or so that have been kind of more stealth QE as well. So in a way, we've already had benefits from other means that mimic QE. And so I don't know if you want to dive into that a little bit, Annie.
Yeah, tell us.
So in a way, especially over the last, 12, 18 months, in a way, we've already had some actions by the Fed and the U.S. Treasury that have already provided some forms of stealth QE. So again, these aren't QE and what we've been talking about it through the Fed buying assets in the open markets. But when you look at the effects they have on the economy and the financial markets, they're basically the same as what QE does. And so back in March of 2023, we had Silicon Valley Bank go under. We had Silvergate go under. We had New York Signature Bank out of New York. So we had a couple banks, due to a change in interest rates, cause them to have liquidity and balance sheet issues to where they had to basically be taken over by the FDIC and the Fed. But as a result of that, in March of 2023, the Fed announced a program called the BTFP program. This was designed to support banks facing liquidity pressures due to unrealized losses on their long-term securities during the time of this banking sector turmoil. The BTFP effectively injected liquidity into the banking system because they kept these underperforming assets. They were able to borrow against them, bringing liquidity and reserves to the bank. Then the banks could go out and make loans, stimulate the economy, and financial, institutions could also, it also led to them being able to use some of these new bank reserves as ways to margin up the collateral that they had, and thus putting it to work into the financial markets. Another way that we've seen a form of stealth QE was the reduction of the reverse repo facility. So as you can see here in this chart, this orange line is the reverse repo facility inside the United States. And so that
looks like a Trump coin chart.
Yeah, in a way it does. So basically what the reverse repo is, it's a facility that allows financial institutions to park excess cash with the Fed overnight in exchange for securities. And so a reduction in this chart, so as the line's going down, that means capital is coming out of this facility. And so it means that there's less cash being stuck at the Fed, and there's more cash going into the banks and the financial markets. And so as we can see, surprise, surprise, when did we see the reverse repo really take off? It was about a year after March 2020 pandemic, where the Fed lowered rates back to zero and unleashed QE. At the same time, the US government did their fiscal spending, aka fiscal dominance, by sending stimulus checks to individuals and also doing the free PPP loans. And so you had so much excess liquidity in the financial system and the banking system that they started to just throw it inside the reverse repo, where they could just keep it overnight. So think of it like a savings account for financial institutions and banks. Meanwhile, the Fed was giving the banks and financial institutions securities that the banks and financial institutions were earning a positive interest rate on. And so in a world of economic uncertainty, it made a lot of sense. But then as we got into the end of 2022, the Fed started to raise interest rates. And then especially as we got into the middle of 2023, the reverse repo facility started to get drawn down. And so as this line's going down, that is a signal of money entering the system and creating more liquidity, which again is stimulative for both the economy and financial markets. One of the big reasons why the reverse repo really started to head lower in middle 2023 was because the US Treasury started funding US debt through T-bill issuance. So since about mid-2023, Janet Yellen, contrary to historical norms for the US Treasury Department in terms of the mix of duration of funding for US government debt, Janet Yellen decided to go above the historical 20% of T-bill issuance in terms as a function of the mix of overall government debt issuance. She decided to spike up and started funding in 2023. I think she ended up funding about 80% of the US debt that year in T-bill issuance. So T-bills are government debt that matures in 3, 6, 9 months and up to 1 year or less in duration. And that has a stimulative effect similar to QE for the economy and financial markets, because the increase in T-bill issuance led to a gradual increase in bank reserves throughout 2023. This excessive T-bill issuance by Janet Yellen at the U.S. Treasury was more than offsetting this QT going on by the Fed. And so even though we should, if we were just looking at monetary policy through the Fed, we actually would have been in a more aggressive tightening scenario. But because the Treasury and Janet Yellen were doing this excessive T-bill issuance, we were actually bringing more liquidity into the financial system, and thus we were able to see stock markets and crypto prices go a lot higher in 2023. Investors, traders, institutions were able to buy this increasing supply of T-bills, use it as collateral, and then margin it up and use that, in some cases, institutions could margin this up to 90%. And then they have all this extra capital that they can use to go out and buy stocks and crypto with. And then the last thing I'll just touch on here in terms of another form of stealth QE, which is now more relevant here in the last couple of weeks and will be over the next month or two, is that the U.S. Treasury has told us that the U.S. government has reached their debt ceiling for the time being. And so now that the U.S. government has reached the debt ceiling, the Treasury Department should not be issuing any new debt to fund the government. And so if they're not issuing new debt to fund the government, then what they're going to have to use is what's called the Treasury General Account, essentially the federal government's checking account held at the Federal Reserve. And so when the Treasury spends down the TGA, so again, as you can see, when the TGA line is going lower, that means that the Treasury is spending money out into the financial system, and that is liquidity being added. That is also similar to what I said about T-bill issuance, is that it can be used as collateral towards margin accounts, and basically it is a stimulative factor that increases leverage in financial markets, both crypto and stocks. And so now that we are at the debt ceiling limit, Janet Yellen, before she left office, said, we're going to have to take extraordinary measures. That means we have to use the TGA account we have to draw that down to fund government spending. As the TGA is drawn down, then in fact, that is liquidity entering the system. But the caveat I will say for the last 2 points, I will say on both the higher percentage of funding U.S. government debt through T-bill issuance and the drawdown of the TGA, the Treasury General Account, is that these factors of stealth QE are likely coming to an end very soon. Okay. Now we're going back to Trump. Now that he's back in office, he's already appointed a new Secretary Treasury, 𝗧𝗿𝗶𝗿𝗃, and he has already communicated that he will not likely be continuing to fund U.S. government debt through short-term duration. He's going to start moving out to coupon, which is going to be, 5, 10-year, and maybe in some cases 30-year bonds to fund the U.S. government. And so potentially, assuming that 𝗧𝗿𝗶𝗿𝗃 starts to fund the U.S. government with longer duration debt, that is going to start to pull liquidity back out of markets. Once the U.S. government finds a resolution for the debt ceiling, whether they raise it or come up through some other resolution, once that's been resolved, the TGA account is going to need to be replenished again. And as the TGA is replenished by issuing new debt, which again could be further out on the duration time spectrum, that is also going to pull out liquidity. So looks like they may be coming to an end, which puts more emphasis on, if we want this crypto bull market to continue to go on much longer, especially towards the end of the year into that October, November, December timeframe, then we do need the Fed to be dovish. We need the Fed to communicate they're still going to cut rates more aggressively than the 2 they said, while QE is very low odds. If in fact we have some sort of event, whether it's economic, banking related, health scare, black swan, geopolitical, that would then probably be needed to be the trigger to get us to zero interest rates and a QE by the time we get to the bull market. Some of the things I want to make sure everyone's aware of is that even though we're all waiting for, just get ready, the money printer's coming, QE is coming. We just have to wait for it. Right now, the probability are low odds that it's going to happen.
With the probability of QE not happening in this cycle, what would you say is the smartest strategy for crypto investors and traders over the next year? Like, let's finish this out by telling people, like, what should you do for the rest of 2025 until you believe that we're going to hit our cycle peak? What is the best way for them to participate in the crypto market for the rest of 2025, the rest of the cycle?
What I would recommend, and again, never giving financial advice. This is just for, purely education and understanding of how markets work. I would say, one, you got to keep watching Annie's videos. She has been spot on this entire bull market.
That's why you're on the team, Jarrid.
Yeah, hey, I'm a company man, so gotta give kudos where kudos is deserved. But definitely keep watching Annie, and I also agree with your advice to focus more on shorter duration trading strategies, swing tradings versus the buy and hold spot bags. Hey, for all we know, the bull market could continue for another year or so. Especially, with Trump in office, anything can happen. He's shown that in the past that he's willing to do things that are unexpected. He's talking right now that on February 1st, so this coming weekend, he's going to start to roll out tariffs on Canada and Mexico. Trump had been talking last week about tariffs on China. And then what do we have? DeepSeek, a open AI platform that is significally cheaper than the American-based AI platforms, and
literally that was a checkmate. What a checkmate.
Yeah, I mean, it's again, China knows how to play the geopolitical negotiation game. So if Trump is going to push forward, especially on tariffs related to China, that could cause a downward move in markets. All in all, I think at this point in the cycle, you're probably much better off in terms of, if you're investing and trading alts, is to really take a hard look at your spot portfolio. If you have spot holdings that are at an unrealized loss or getting close to being at break even to a loss, it might be time to evaluate whether or not you continue to hold those. One thing I think about doing is I think of it like a sports team. So I look at my crypto spot portfolio. I don't have many. I'm mainly concentrated in the big layer ones. But I look at my spot portfolio like a basketball team or any sports team's roster. The assets that are doing better, aka going up, they get more playing time. And playing time for me is my capital. So if they're doing well and playing well, they get more of my money. If they're not doing well, then they get put on the bench, and I take capital away from them and I give it to my assets that are performing better. And so that's kind of how I see my portfolio, my spot portfolio, is I treat it like my sports team roster, and the Bitcoins and the Solanas that are doing well, they get more playing time in the form of, I take capital from the assets that aren't doing as well, and I move it to the ones that are doing better. And eventually I make slow adjustments, every week or so. And my portfolio naturally starts to be more concentrated into the assets that are still holding up and going up. And I'm having less exposure to the altcoins that are not doing so well. So maybe that might be something that, the audience might want to consider here. And then aside from, just doing that with your spot bag, moving to more of a weekly, multi-week or multi-day swing trade, definitely, I don't know of a better strategy for that than inside the TTC community. So, definitely focusing on that is what I would point people in.
Yeah, awesome. I really love that strategy of moving into stronger alts. Jarrid, that was a really incredible breakdown from you today. Thank you so much for giving us your time. I know that you prefer to be behind the scenes at TTC, but I just, you bring so much alpha that I just wanted my audience on social media to be able to meet you and just see all of the value that you can bring and really help us break down the absolute likelihood. Like, is there really a high chance of QE before this cycle is due to end? Because if that is what people are crossing their fingers for, I think that's a very dangerous strategy and a very dangerous reason to be holding on to underperforming alts. Would you agree with that?
Yeah, 100% agree with that. And, I myself have to be aware of this, but definitely encourage the audience is you have to check your biases. So you may believe in a story so strongly that you're ignoring price action, because at the end of the day, only price pays. And so if you are holding some altcoin and you believe blindly in the story, or you're expecting the story to play out, but the price is telling you something different, don't get stuck in, sunken cost bias, because we see this a lot in retail investors in the stock market. They'll buy a stock at $100 a share. It goes down to 90. They think it's a better value. They buy it at 90. It goes to 80, and they convince themselves that eventually it's going to get back to 100, but it keeps going lower, and then they get stuck. And they only meant to hold something a few months or a year, and now they've held it for multiple years, waiting just to get back to break even to stop the pain. Meanwhile, if they just would have realized that the price action and what investors in the asset were saying had changed, and they would have just cut their losses at 90 and only lost $10 and moved that into another asset that kept going up, they would have been much better off than if they had just held on longer than they needed. So I go through it all the time. Is I just always am checking my bias to say, what is price action telling me? Where are we in the larger cycle, crypto cycle? And like I said, moving my assets and moving them from the stronger assets away from the weaker ones, making sure that I don't get stuck in expecting this cycle to look like prior cycles.
Yeah. Exactly. Amazing. Thank you so much, Jarrid, for your time today.
Yeah, thanks, Annie, for having me. It was a blast. Look forward to doing it again if you ever want me back.
Absolutely.
And
For sure. Thanks, Jarrid. Guys, if you got value from this video, make sure to hit like and subscribe so that you can be notified every time we upload a new video. And I want to hear from you. Do you still believe a big alts all pumped together type of alt season is coming? Or does what we discussed today change your perspective? Drop a comment below and I'll see you on the next one.